Hey, welcome back. It's Jeff back again with another video. I know that it's been quite some time since my last video, and I think work has been a little bit hectic, so upload schedule is not as frequent. But I just want to come back with a quick market update, some sort. It's going to be a quick video, probably about 10 minutes, hopefully lesser, I don't know. But I want to talk about the market data, right? The jobs data that just dropped last week. I want to talk a bit about some headwinds that every investor need to be aware about. I want to talk about some rate cuts situation. I'm going to talk about some AI stuff as well. So yeah, stick around if you want to find out what this could mean for your portfolio. Could be helpful, could not be, I don't know, entertainment, All right, so first up, let's talk about the week jobs data, right? I think that was one of the craziest part last week when the jobs data finally dropped. It showed fewer openings, rising unemployment claims, which is a huge red flag for the Feds because that's basically one of their dual mandate, which is to ensure that they have max employment. This could mean that the market is starting to lose a little bit of its momentum, starting to show a little bit of consumer spending and growth going down as well. So generally, I think that's going to be showing a little bit of some bad news for the sectors that's going to have some strong demand, right? Especially, let's not forget about the significant revision on the downside for May and June, right? You suddenly just lose out 283,000 jobs. That's a lot of that's a lot of job cuts for a revision, right? And of course, when the Feds came out with the FOMC meeting, they were talking about how, the market is still pretty well, jobs market is strong. But this report came out 2 days after the FOMC meeting, right? So who knew, right? Maybe Jerome Powell knew and he just decided, oh, it's okay. Maybe we'll just revise it down. Some say it's political, some say it's not. We don't know, okay? Forget about it. But anyway, I think that that's going to be some cause of a concern in the near future. So something that you really, really want to think about. Now, we also have to talk about the Feds, clearly, right? Because with inflation significantly slowing down already, let's talk about some possible rate hikes. During the recent FOMC meeting, they were talking about how the September FOMC is going to be a 40% chance of a rate cuts. And of course, with the drop of the jobs data, it's gonna be 100%. We have currently it's 99%, but let's be honest, okay? It's gonna be 100%. We're gonna be getting a rate cut in September. If Jerome Powell still choose not to cut rates in September, chances are the market will go into recession. Straight up from that. Honestly speaking, I think whatever soft landing that Jerome Powell was dreaming about is all going to be going out the window. The moment he stops, if he decides, let's just stay with the rates for now. I think, of course, with lower rates, you definitely would help different sectors such as housing, such as any interest rate sensitive market, right? Your energy market, anything that costs that has a high cost. Those kind of high cost, high demand sort of sector, those are all going to be very, very interesting to look at. I think there's going to be somewhat of a volatility run around there. So I think investors should definitely be more cautious. Now, let's talk about AI as well, right? I think AI investment is starting to be a little bit of a concern. I think companies are pouring money into AI, and I mean pouring money into AI, okay? Analysts are even warning that, companies are maybe overspending on all this expenditure without actually seeing immediate returns. And I think if the hype doesn't really match up with the reality, I think maybe in the next 3 to 6 possible quarters of earnings, maybe we're bound to see somewhat of some disappointment to come eventually. I think just look at Meta, right? Let's talk about Meta right now. Okay, Meta is aggressively hiring AI talents across the board, right? Recently, they spent, I think, $100 million to sign a new AI talent from Apple. Few months back, they signed 6 or 8 people from OpenAI. So I can see that they are aggressively hiring from the best AI companies in the world. I get it, because they are trying to bolster its AI initiative and all. I completely get it, and they want to be the forefront of the AI innovation. But my concern is more so that with such a rapid expansion, it usually comes with very, very severe financial implications. And the problem with financial implication is not that, they cannot afford it. I'm pretty sure Meta can afford it, okay? Especially back in 2022 when Meta spent, $200 billion on VR. And they're still burning money on VR right now, okay? Like right now, if you look at the earnings, like Meta is still burning money on Reality Labs. So I think Meta got money to burn. But my concern now is that if Meta is going to be spending so much money on OpEx right now, what's going to be happening is that they are going to effectively start to justify the fact that, our OpEx is going up, hence we have to do a little bit of a layoff. And then they're going to start laying off and saying that, it's because our AI initiative is doing really, really good. And because of that, we need 8% less employees, and they're going to lay off about maybe 6% of their employees and such. And when that actually happened, there's going to be what's happening when I was talking about this on Instagram as well, which is my concern, right? And back in 2021 and 2022, when Netflix first released their earnings, was a terrible earnings because they beat on expectation, and then afterwards they immediately guided something that was horrendous for the next quarter. That basically set out alarm bells for every single companies out there. And after that happened, shortly after, they started laying off, and then you start seeing Microsoft laying off, then you start seeing Apple laying off. Everyone started laying off one after another. Every single day you look at the news outlets, you're going to see one big company starting to lay off a percentage of their workforce. And that was the part where I was really, really worried, right? Because in 2021 and 2022, a lot of people said that it wasn't a recession, but let's be honest, it was a technical recession. So that technically did happen, right? And that was all brought forth from layoffs. And I think that what this overspending on OpEx could actually do for Meta is that we might see layoffs happening due to the high expenditure for OpEx, and then eventually we are going to see them start to trickle down into the recessionary part of the economy. So I think that's going to be a little bit concerning, right? I think that all this investment, okay, I do think that, investments for the companies itself, right? I think for long-term growth, it's important for them to hire high quality talents, and keeping them in the company is going to be important. But of course, I think generally across the board, a lot of companies want to stay competitive. They're going to be trading their talents like how they trade basketball players, right? Or soccer players, right? They're going to be trading all these people very, very quickly. They want to stay competitive in this space, especially for AI, right? AI is in such a fast-moving pace kind of environment. So I think investors should really be more aware of the potential short-term financial strain that's most likely going to be happening. Personally, I don't think that we are going to be seeing some crash, okay? Honestly, again, I don't want to sound like this person who is like constantly bearish on this whole entire market. I'm not, okay? But I think that the optimism in this market right now is crazy. I don't think it's misplaced because they are showing earnings for it. That means that they are showing optimism because they are showing results for it. I get it. But personally, I think this is kind of like a gut feeling kind of thing. So I feel that maybe keeping a little bit of cash by the side would most likely be helpful. And when you do see a little bit of a dip, maybe you want to buy it up. The issue now is that the market is so resilient to any sort of bad news, right? Because even with the market data that came out last week, when that came out, the market kind of dropped, 3-4%? It ended flat on the day. And the day after, immediately back another 2%, right? So no one really cares. And I think that I'm not sure about the M2 money supply. I have this odd feeling that the M2 money supply is still increasingly significantly over the past few months. However it is working out, but I think that definitely you want to be more cautious on the short-term potential financial stuff for the companies that you are really getting into. And I think even for the earnings, right? For the earnings season, right now we're looking at it. And like for S&P, 82% of S&P 500 is doing fantastic, right? 82% of them beat on earning. But let's not forget the same thing, right? S&P 500, honestly, is just the Max 7 and S&P 493. And the issue is, I know that it sounds pretty obvious, right? 500 minus 7 equals 493. Okay, but that's not the point. I'm saying that if you were to actually exclude a Max 7 out of the S&P 500, S&P 493 actually suck, right? S&P 493 is doing what, 2% like year to date. Okay, like S&P 493 is actually suffering. The only reason why S&P 500 sounds so wonderful is only because of the Max 7. So I think that this earnings seasons, of course, everyone's just looking at the 7 companies. But I think that, we are going to see a lot more volatility, especially with the next few seasons, right? We're going to see the next few quarters where the earnings are going to be coming out, and then we're going to see some changes. Okay, we're going to see some changes in earnings. We're going to see some changes in expectations. Those are the things that we really want to look out for, right? All these different companies, we're going to see if the price drops. We're going to see if guidance get revised down. I think tech and real estate is going to be very, very interesting. And I think companies who, because it's going to be very, very strongly dependent on the interest rates. Right now, every single company in the S&P 500 loan money from an institution. It could be from the government, it could be bonds, it could be like cash covered bonds from another different company, whatever it may be, right? So all these kind of different loans would be affected with the percentages that we are going to be talking about. So honestly, I think what you should really do on it, okay, first of all, you got to stay calm, all right? You got to avoid panic selling. I think diversifying your portfolio is going to be important. Okay, consider some defensive sector. I think maybe healthcare, maybe utilities, but honestly, I'm not going to be that into those sectors. Personally, I think just staying into cash for like a good 20 to 30% and waiting for a time for you to buy into some dips, that's going to be good enough for you. I think reassessing some positions if companies are going to be too exposed into AI overspending, I think these are some of the risks that you would have to really look into as well. Okay, but anyway, to sum this up, okay, the market is going to face some headwinds in the short term future. I'm not sure, but I think with some right strategies right now, I think you can weather this storm pretty easily. And I think it's pretty obvious as it is already. Okay, market just keeps going up. Okay, even if the market were to crash, it's gonna recover in the next 5 to 10 years. Everyone kind of knows that as it is, but I think that it's important for you to kind of time the market when you can, and especially when everyone is so giddily optimistic. Maybe you can actually take this time to earn some money by the side. But anyway, if you found this video helpful, do like and subscribe. And let me know your thoughts in the comment down below, right? All right, I'll see you guys in the next one. Peace out. Bye.